and welcome to Fidelity Connects. Today marks President Trump's first day in office, and U.S. equity markets advanced at the open. They're still sitting in the green. Investors, of course, will be watching Trump's trade policy and other key pieces of his agenda, along with a few earnings reports, which are due out this week that will be potentially moving markets. So how ultimately are our next guests navigating some of the current market environment pieces that we see here unfolding? Joining us now to unpack where they are finding growth opportunities in 2025 are Fidelity U.S. Growth Opportunities Class Portfolio Managers, Kyle Weaver and Becky Baker. A warm welcome to each of you on a pretty frigid time on the eastern coast of North America, I must say. Great to see you both.
Thanks for having us.
Good seeing you, Pamela.
Delighted to have you here and to talk about things that are growing. We're going to talk about the fund. Kyle, I would love it if you wouldn't mind to just remind us, bring us up to date on how much today matters and how much a little further out matters. You look at growth, how?
Okay, sure. Yeah, thanks. And thanks for everyone for being on the call. So, every day matters, but we are growth investors and that care about valuation. And what we really care about are the days between now and call it 2-3 years from now to 7 years from now, that the business models we own can generate free cash flow, get to profitability, make progress in their plans, and become very, very cheap on a multi-year view. Some of the holdings in the fund by design are already cheap on a near-term view. We call that kind of the resilient growth bucket. And then other names don't look like they look like they're very far from profitability, and that could either be because they don't have a commercial drug yet, and they're still in the phase 2 or phase 3 of the FDA process, or it could be that they have a business model that invests a lot up front in hopes of leveraging fixed costs later on down the line. And that's kind of on the other side. We call that kind of our breakthrough growth bucket, and we're thinking of renaming it the Phoenix growth bucket because there's some names that have already kind of been through a near-death experience and we think are coming back. But the bulk of the fund, the meat and potatoes of the fund is in kind of the middle bucket we call the strong long-term growers. And anything that's a major index component by definition in the Russell 1000 Growth Index is one of these strong long-term growers. It's a terrific index. The best companies in the world are represented there. And we have a lot of exposure to those names, but we try to find pockets of opportunity where the market already maybe overappreciates some of the index components. And we think we can find better opportunities either in the breakthrough growth or in the resilient growth bucket, which also has the benefit of, if I may just sort of key point number 2 on how we try to run the fund is to position it so that it can take advantage of volatility. And that means, owning some cohorts of stocks that don't behave the same way at the same time. And that's kind of part of the thinking behind having these 3 buckets of stocks is to position the fund so that when, say, breakthrough growth goes out of favor all at once and the market sort of sells off everything with a high growth rate and low profitability, once we have capital in other parts of the market that's behaving very differently, gives us a source of capital to kind of reload on some of our favorite ideas in the fund that it may have temporarily fallen out of favor. So that's what we're trying to do, buy cheap stocks across a spectrum of growth profiles and put it together in a way so that we can take advantage of volatility when it occurs.
So interesting. And I remember so many discussions actually during the pandemic, and growth took on sort of a new twist. There were interesting names that were in there. We'll come back to some of those and some of the ideas that are in the fund in a second. Becky, if you don't mind, I would love your impressions just on yesterday at the inauguration. It was a tech-heavy innovation, faces of innovation in America kind of day. It was astonishing to see. Your fund traditionally has had a number of those people who are at the head of many of these big companies in it. I'm just kind of curious how you see is there a new cusp here? What was your impression of yesterday, taking a look at that aspect?
Yeah, I think your point is right that it was an important visual for the country. And I think maybe what it reflects is some of these big tech companies, their original business was straightforward areas like cloud software or social media or making phones or whatever the example is for the relevant company. And I think that was sort of the first and second chapter of their growth. And maybe what this reflects is that this next chapter of growth for I think many of these companies reflects even bigger ambitions. So whether that's like AI, which I think has potential to touch every part of the economy, or autonomous vehicles, where you're going to need regulatory approval to be able to actually move forward with those, or ambitions in space. I just think what these companies are hoping to achieve is bigger. And I think it makes sense that they'd, like to be aligning themselves with a new incoming government, given the importance of all of those areas.
Absolutely. Let's talk a little bit about how the fund has, or maybe hasn't, changed from last year. Kyle, I'll begin with you for a couple of impressions on if you went back 12 months, just how different things look.
Sure. I mean, I think, and Becky can maybe build on this later, but I think we many of the positions are very similar to what they were before, because by definition, we are looking for these ideas that we can hold for at least 3 to 7 years, and some of them hopefully forever, as the story continues to unfold. So there is, there's probably more similarity than difference in terms of what the fund looks like now versus a year ago. I think the largest difference in my view, and then I'll hand it over to Becky, though, because really I think I owe her the partnership with her a lot to this, is there are a little bit fewer names in the fund than there were, and especially some of the smaller names that I had invested in 2 or 3 years ago and had really been through some rough times and were looking for a kind of the promises from the IPO period that they'd come public. Many of those just a combination of first finding very high conviction ideas in the larger cap names that we own, and secondly, just putting many of those names in the kind of too hard and doesn't matter bucket, and cleaning up the fund in that way. It's a little bit more concentrated fund than it was a year ago. And there are probably some other nuances that I'm missing. I mean, I'm not trying to dodge this question, but we try to take a fresh look at the fund every day. Obviously, it usually doesn't change so much from day to day, but thinking back to a year ago, there have been a lot of events that have unfolded that have caused us to look at kind of the risk reward on every one of our business models that we own.
Yeah, I think what I would add to that is, today, I think it's 60 or 70% of the fund is sort of in that middle bucket that Kyle described, the long-term growers, whether that's like a Microsoft or an Amazon or a Boston Scientific, just really high quality companies that are growing fast, names you'd expect to find in a growth fund or a growth benchmark. And then it's probably 15 to 20% of the fund that's in the other two buckets, either the breakthrough growth or the more resilient. I think in the more resilient bucket, a lot of the names look exactly the same as they did a year ago. T-Mobile, Flex, these are companies where things aren't changing very fast. We really like the management teams. We really like the execution, and we've sort of stayed with those. In the breakthrough growth bucket, I think there has been a little bit of change in exposure. As Kyle said, there were some names that weren't performing the way we expected them to, and so we exited positions there. Other names like a Carvana or a C Limited have really been great contributors to the fund over the past year. And I think we feel, good about continuing to own those. And then we've added new names as well. And AppLovin is a name that we didn't own a year ago and that we got to know starting probably 6 months ago. And I think we've built conviction there over time. So I agree. I think the composition of the fund hasn't changed that much, maybe a little bit less exposure to breakthrough growth than a year ago, but some of the names in that bucket have changed.
So, Kyle, because there is an argument in the markets that some of the big names, I mean, Mag 7, but others, are overvalued. I mean, there are people who take that position of, oh, this is a time to ease up. And, how do you respond to that with perhaps sticking with certain names?
It's always possible. I think the reason that they're perceived they're easily perceived to be overvalued is because the stocks have gone up so much. Dig just one simple layer deeper, though, and it is their earnings growth that has propelled them upward far more than the multiple that they're trading at. There's been some multiple expansion, but actually, I think a little bit less than for the other several hundred names in the market. The earnings growth of these companies has been astounding. If you don't think that the earnings that they're generating today are sustainable, then they are expensive and overvalued. If you think that they can build on the earnings stream that they've already achieved and continue to grow at a healthy double-digit rate for years to come, then these are pristine business models with fortress balance sheets and enormous free cash flows that are dominant in the industries they operate in, and can do things that other companies can't. So I think it's, and that's about the extent of the similarities between them. I would also just add they often get lumped together as a group, but we look at each one very individually, and each one is kind of a special story in its own right. If you think that they can sustain the earnings that they have, these are going to be cheap stocks over the fullness of time as well.
So interesting. Becky, I might use that as a jumping off point to talk a little bit about, adding to that is this discussion that, can margins stay the same for some of these massive growing companies that are enormous and that just throw off free cash flow and so on. And some will say they're still going to grow very, very quickly. It's just not the very quickly of last year. So maybe nothing wrong with that, just a slight change. I did want to ask a bit about margins, generally speaking, and earnings on some of these companies going over, again, maybe the next year, which may not matter because you're looking even further out. But are we going to see a bit of a change in terms of what has been reeled in on the earnings front from some of these big names?
I think I feel pretty good about the revenue growth story, the margin story, about the overall positioning of the Mag 7. There's been a lot of hand-wringing, I think, in the market about the level of investment required to build out what's needed for generative AI. And there's been concern that these very strong companies with very high margins were going to have to take the margins way down in order to make this level of investment. And I just think we've seen some of that. So I think on average, the big hyperscale tech companies have seen free cash flow margins go from the high 20s to sort of the mid 20s over the past year. But I think that just speaks to how powerful the business models are, that despite an enormous investment cycle to the tune of $100 billion plus that's propelled NVIDIA's success, we almost don't even see it in the financial statements of these companies because they're so big and because the top line growth has been so powerful and because they've also pulled back on operating expenses to support some of the capital they put behind AI. So I would say I hear a lot about the risk to margins at these companies because of what's needed if you want to be an AI winner. But so far, I think we've seen a lot of investment and margins have held up really well, which I think is a comforting point.
Amazing. You don't even see it. I mean,
right. It is unbelievable.
Kyle, take this further. We talk about the AI infrastructure build out. What does that mean? It's meant semis, obviously. Is that all it means for you in terms of your investments?
Yeah, we like to try to find, the undiscovered places to invest that can take advantage of this theme. It's been a pretty well picked over space at this point. We do have a lot of semis. We like the semi bets that we have. In the past, we've looked at some of the companies involved in the electrification of the data centers and the cooling. Some of those also, I think, in the market's enthusiasm became expensive and no longer necessarily fit our criteria of looking cheap on a 3 to 7 year view. But other names we continue to hold that are very involved in supplying just electrons, just power to the data centers that are so hungry for it, and that's really become the main bottleneck for a lot of the data centers and the compute that is going in for the hyperscalers. So I think, there's a large independent power producer that's been able to reprice a lot of the clean energy that they produce on behalf of customers at kind of increasing rates because customers are so willing to pay a premium for reliable, consistent carbon-free energy, and that's really propelled their business model over the past year. So that's been a great discovery, really helped by our Fidelity research and the utilities team in sort of unearthing that one and seeing the full potential of that. And we're always looking for new ideas as well.
Becky, would you say, bring us up to date on companies that you're speaking to that are implementing various aspects of AI? One thing I was going to ask you about is really going into sort of robots, going into self-driving cars, which I feel like we've been talking about for almost as long as I've been alive, but it's never really moved. Certain things are really starting to move, though, on this front.
Yeah, I think so. I think, well, first of all, companies that are investing in AI, I think are maturing in the way that they think about those investments. So NVIDIA continues to be the leader in AI infrastructure and is a very important holding for the fund. But we also see some of the companies that provide custom ASICs, whether that's a Broadcom or Marvell, their businesses are really starting to benefit because some of the earliest spenders on AI, they still need the NVIDIA chips, but there's some pieces of their business where it's specific enough what they want to do with the infrastructure that they actually don't need the general purpose best in class from NVIDIA, that they need something custom. And that's where a company like a Broadcom or a Marvell comes into play. And so in the most recent quarter, we heard very bullish outlooks from those companies. I think Broadcom said their business in AI is 12 billion today, and looking out 3 or 4 years, they think it could be 60 to 90 billion. So a multifold increase. So I think that's an important development we're seeing. And then, yeah, as you said, we're starting to see AI move into the physical world. And here I would say we are much earlier. So whether that's autonomous vehicles or humanoid robots, we're starting to see tests in cities like San Francisco and in Phoenix. I think we have companies moving into Miami, Atlanta, Austin this year. Tesla has their cars everywhere. And, with the help of a human that's still responsible for the performance of the car, they're making great progress with full self-driving, where the human interferes far less frequently than they would have 6 months ago or a year ago. So I think progress, and similar in humanoids, we're seeing companies begin to put these human-looking robots on the floors of their factories and test to see what they can do. And I think the reason why that's related to AI is because if you can give a humanoid robot a world model, knowledge of what the robot is looking at, then you don't need to tell it every single little thing it needs to know. If it's picking up an orange, it needs to hold that a lot less tight than if it's picking up, a ball or something that's heavier. And so giving the robot world knowledge through the use of AI can really, I think, accelerate the pace of progress there. So yeah, it's earlier in the scheme of all the AI things that we talk about. And I don't think we have a lot of capital invested behind humanoids today, for example, but it's definitely an area that I think you'll hear us talk more about in the next year or two.
Check back in with you on that. Kyle, I want to move to an area that I know that actually you don't really like being asked about macro at all. In fact, please don't ask me anything. That said, there's a rate story and there is a cyclical story. And I'm wondering if there is anything that's cheap and interesting that's tied to that.
Yeah, there is stuff that is cheap and interesting that is tied to that. I think you're right that I don't really like talking about the macro just because I don't have an edge on it. I don't think our view tends to be very differentiated. The Fed itself has trouble understanding the macro, and they have all the data points and help set the policy that creates the macro in the first place. So I think it's very difficult, for investors to have, but the way we try to invest is along those key criteria of looking out 3 to 7 years and seeing whether there's a range of reasonable parameters in the macro, finding business models that are not overly sensitive to that range of outcomes. And by the way, if they are too sensitive to that, then they're usually they don't qualify really for investment because we don't feel like we can predict, earnings 3 to 7 years out. It all depends on a very narrow view of a certain macro outcome. But there are times, and I guess I'm thinking of like our investments in the housing space and in the automobile space, where it looks like the cycle for those industries is already at trough or trough-ish levels. We don't necessarily know when United States will come out of that. We don't know what rate environment will cause it to improve, but we know that we're already more than 2 years in to a 3-year into a housing downturn, for example, that we're at levels that really have to go back to the GFC in 2008 to see the kinds of trough levels that we're seeing today. We've been at that point for a long time, and I think there's reason to think that things are more likely to get better than worse from these levels. And there's some of the names in the fund, and we think are good secular growth stories, kind of long-term winners in their space, almost like enabling technologies or enabling capabilities for the home building industry or for the realtor industry, and that will at some point have the wind at their backs instead of in their face. Many of these companies are already growing decently well with the wind in their face, and we're sort of excited to position the fund so that when the wind is at their backs, the fund shareholders will benefit.
Fantastic. Anything to add to that, Becky? There's actually a great question coming, which I'll put to you next, but was there anything to add there?
No, I think Kyle described that perfectly. Yeah, trying to take advantage of hopefully short-term weakness so that we can buy long-term growers at a discount to what we think they're worth.
Perfect. Okay, here's a question. Could you put this to you, Becky? Could you speak to your sell process? Any lessons learned?
Yes. So I think our sell process is we sell ideas when we don't think that they look cheap anymore, looking out 3 to 7 years. And I would say companies arrive into that bucket 2 ways. One is that the fundamentals disappoint relative to what we expected, and we're confronted with the reality that the stock is no longer cheap, even if it hasn't worked, and we have to move on. And so we did do some cleaning up of some of the long tail positions. I would say about 6 months ago, we probably wrapped that up. But it's part of the reason why name count has come down is we decided we didn't need to wait for fundamentals to improve for a company where we feel like things had changed such that the investment thesis that we had wasn't right anymore. And then we do trim our winners as we think that they approach something closer to fully valued. That is, I think, a little bit of a harder exercise because sometimes you're collecting data points along an investment journey that force you to continue to revise your estimate of what the company is worth up. And so we have some stocks like Carvana or a C Limited that were great contributors over the last year, but where pieces of the business really surprised relative to what we expected. And so we do still try to trim those names because they're not as misunderstood as they were when they were, trading at a third of the valuation where they are today. But our view has also gotten more positive. And so I would say it's a moving target about, what do we think the stock is worth and where is it trading relative to that?
So interesting. Kyle, you were laughing a little bit there when she was talking about sort of cleaning things up a little bit.
Yeah, no, I mean, you hate to sell a stock because you were wrong about it, but that's the most important sell discipline there is, and so there have been a number of names where the results disappoint. Maybe, when we decide we might question whether it's transitory or not for one quarter, but eventually, we think there's better ideas. There are a lot of other opportunities where, the stock reaction, some of the names that are our largest positions in the fund are names where the stock reaction has been disappointing, but the fundamentals have actually really been strong or surprised us. So that, I think where we feel the best is in those instances where our fundamental view of the company is improved over the last year, even though the stock price has not reacted, and in some cases really lagged the market by quite a bit. But that's where we try to take a real bet and look forward to hopefully being our views being validated, over the next year or so.
Becky, just swinging back to some of the many faces that we saw as the new administration was inaugurated yesterday, it brings you back to some of the stories associated with those founders in a lot of cases. And one of the things I think we wanted to talk about was actually virtual reality, because that is a theme that also has been knocking around for some time. Is it still valid? Is it interesting to you?
I think it is. Virtual reality and augmented reality is an area where Meta specifically has been investing heavily for a long time. They even obviously changed the name of their company to Meta to reflect their level of focus on that. And I would say the jury is still out. Unlike AI, we don't have 1,000 data points from basically every company we talk to about how important it is to their business. So it's definitely still a little more speculative, a little earlier days. But Meta has been investing really heavily in their Reality Labs segment for years. And I think the market a couple of years ago thought this was going to be a complete waste. So it's like a 20-ish% drag on their earnings. And people thought they're never going to be able to create hardware that people want. They're going to lose to Apple. And this is going to be just a waste of money, over many, many years. And so the market sort of put a normal multiple on Meta's stock, despite this big, what we think is transitory investment. Either it will work and they will have a great product, or it won't and they'll shut it down. Either way, you'll sort of get that level of earnings back. And what I think has changed in the last probably 6 months is that Meta has shown the market two things. Number one, these Orion glasses, they prototype to a bunch of reporters and people in Silicon Valley that are, I think, the vision for where their glasses are going. And then a more basic version, their Meta Ray-Ban glasses, which have the ability to play music, to take pictures, and you can chat with your assistant in your glasses and ask it things. And so I think seeing those two products, that they're real, that people like these glasses, even if it's just an early version of them, has given the market a lot more optimism that Meta is doing something real here and they have a chance to be a winner in this market. And so as shareholders, we're obviously happy to see the progress publicly, and it's an area we're going to keep watching.
Kyle, I'll ask you to just kind of wrap up, speaking to Canadian investors who, are usually making Canadian bucks and looking to invest them elsewhere. I mean, the fund has been on a tear over the last several months. How would you like to sort of close out and make the case a little bit?
Right. Well, I think it is helpful sometimes when the top down seems a little bit heady to just go back and look at the bottoms up view. Like, what do we own in the fund? What is the fund made of? Forget it, whether the fund is up 40% or 30%. Like, what companies comprise it? And when I go through like our top 10 holdings and everything below, these are still names that we think are legitimately pretty cheap on a multi-year view. I mean, some of them are not as cheap as they were before. Others have become much cheaper over the past year because the stocks haven't performed the way we expected them to, even though they're a year further along their journey and the fundamentals have improved and in many cases really positively surprised to the upside. So there's also, there's just a wide variety of names. The big six is one big bucket, or the Mag 7, and that's almost half the fund, but there's a whole nother half of the fund that has everything from, biotech to energy producing utilities to healthcare names and industrials and consumer names that, are at cyclical troughs. So, my biggest holding.
Go ahead. Oh, don't leave us hanging. Your biggest holding.
Yeah.
Becky, I'll ask you just to round up sort of, final thought.
Yeah, I mean, I agree with everything that Kyle said. And I think the part I would add to that is a lot of the themes that drove the success of the fund over the last year, whether that's AI, connected TV, trying to lean into areas of macro weakness so we can take advantage when the wind is not at these companies' faces, it's at their backs. Those are the same themes that we are excited about going into next year. We think AI is a multi-year investment cycle for the companies that are focused on it. We think it's spreading now into enterprise, and we're just sort of hitting that S-curve for generative AI. This connected TV effort from Netflix and Roku, and it just started maybe a year or two ago, trying to bring advertisers in to what they're doing and really build out the tools that those advertisers need. So we feel like that could even be more of a 25 story than it was a 24 story, and housing and autos and all the things that Kyle talked about. So I think it is a lot of the same things that we're excited about. And that's one of the things that gives me optimism about where we're headed.
Fantastic to speak to you both. Kyle, sorry I cut you off there at the end. We love talking to you, and great success going forward. Thank you for spending time with us today.
Thank you, Pamela. Thanks everybody.
Pamela. Great to see you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.